Episode number 5 of the Insurance Awareness series by Mr. Deepak Godbole. Risk exposures, risk attitudes, information asymmetry and adverse selection, ideal requisites for insurability. Exposure to living longer or dependent old age, death and sickness or disability are examples of personal loss exposures. Property owners face the possibility of both direct and indirect or what is known as consequential losses. Property loss exposures are associated with property such as buildings, contents and other property such as factories, warehouse and automobiles. There could be partial damage or total loss of physical property. Consequential or indirect losses are non-physical losses such as loss of business. Under most legal systems, a party can be held responsible for the financial consequences of causing damage to others. One is exposed to the possibility of liability loss, that is, loss caused by a third party by having to defend against a lawsuit when in an interaction, someone is hurt or some property is damaged. People's attitudes toward risk affect their decision-making. It is crucial to understand behavior associated with risk management activities. Different people have different attitudes toward the risk-return trade-off. People are risk-averse when they shy away from risks and prefer to have security. A risk seeker prefers taking risk with a hope or presumption that a positive long-run return is possible. A risk neutral is where the risk preference lies in between the two extremes of risk-averse and risk-seeker. Information asymmetry can cause problems in any market. This is a problem encountered when one party knows more than the other party in the contract. In particular, it addresses how information differences between buyers and the sellers, information asymmetry, can cause market failure. These differences are the underlying causes of adverse selection, a situation under which a person with higher risk chooses to hedge the risk, preferably without paying more for the greater risk. Adverse selection refers to a particular kind of information asymmetry problem, namely, hidden information. In other words, adverse selection is the phenomenon that bad risks are more likely than good risks to buy insurance. Moral hazard is the phenomenon that having insurance may change one's behavior. If one is insured, then one might become reckless. Many risks are uninsurable. There are requirements that must generally be met if a risk is to be insurable in the market. Some of the requirements influence the consumer demand for insurance and look at what is economically feasible. The other requirements influence the willingness of insurers to supply insurance. Await more information on risk management and insurance through this Risk Management and Insurance Awareness initiative by Mr. Deepak Godbole.